Hello and welcome to This Week in Property. I'm your host Richard Swan, and in today's show we have another guest dialed in remotely in this wonderful time of the pandemic. Sadly we can't have him here in the studio in Glasgow, but we're going to have a fascinating chat about a fascinating subject inside the world of property. Now, we all know the famous international law firm Reed Smith, and this gentleman is part of that, a very important part of that. He is a partner in their structured finance team. So he knows a lot about the industry, a lot about the economy, and he's got a fabulous background as well, which no doubt we'll actually delve into just to kick us off. But first of all, he is Mr. Iain Balkwill. Iain, hello and welcome to the show.
Good morning.
This is fabulous. Really appreciate you giving us some time here to chat about a very particular subject. I'm quite sure we're going to get your kind of high level of everything. You know, what's your thoughts on the economy and where things possibly going, etc., and so on and so forth. But there is a very particular niche part of that we're going to delve into. But first of all, for the listeners, to help them out, yourself, quite a background, you know, when you look back on various kind of blue chip companies, shall we call them? You know, You've had Merrill Lynch's and Barclays, Bank of America, Bank of New York, Mellon. My goodness, you've been about, as they say. How would you summarise your career? You know, if someone had bumped into you and said, "Yeah, so how did you get to this point? You know, dealing with Reed Smith and so on." How do you look at things when you look back on your career and the paths it's taken?
Yeah, it's a very good question, because I was actually, when I was at university, I actually studied environmental geoscience.
Wow.
Main reason being, you know, I basically like rocks. I love geology.
Right. Wow.
And so that was where I sort of started off. I always wanted to do a bit of law, and so as all good students do, I applied for my training contract. I was very lucky to get a training contract in a great law firm in the city, and I really thought that I would be doing project finance, because I thought the idea of building reservoirs, airports in the third world, using my knowledge about rocks in law, I thought would be a brilliant thing. But lo and behold, I sort of went to a firm which specialised in structured finance, and one of their great areas was in the sort of CMBS field. For those listeners that are not aware of what that basically means, that basically involved, it's a form of financing of commercial real estate. And so my ideas about project finance sort of fell out the window, and I just got thrown into basically working on CMBS.
My goodness.
Which for me was a great thing, because I was doing some great deals, but when it came to conversation with my peer group and my friends, I had no chat anymore. So.
Of course. And the rocks disappeared, gone. I mean, how do we feel about that personally? Because you obviously had an interest in it, a passion in it.
Yeah, well, if you look on the shelf to my right shoulder, there are some books about rocks, and I occasionally, you know, I might pick a book up and think, gosh. Or when you hear about a volcano exploding, I always think that's quite interesting. And you can do some structured finance stuff around catastrophe bonds associated with volcanoes. I think that might be an interesting thing to maybe delve into one day. But
yeah.
For the time being, it's all about CMBS.
It's all about the CMBS. I love that. I love when you're trying to connect the world. So that's fantastic. Good on you. Good on you. That's what we should always do. You got to have a bit of fun in business and life and so on. So you touched upon it. CMBS. This is the topic for today that we really want to talk about, because there's quite a bit of news about it. There's quite a bit of background on some of the changes in it in the market and so on, and the numbers, the money involved. And it's an area that you, your team, etc., your company, not even just looking at, because a lot of people with the pandemic, they're trying to, God, I'm just hanging on, I'm just trying to survive. And this particular area in the economy, we're just going to see how they're. You don't just think that it could survive, but you've got feelings and opinions and experience thinking that actually this could really flourish, this could really go beyond. So that area, you touched upon it, CMBS, so commercial mortgage backed securities. Yep, happy with that. So that's just to kind of tie the listenerships in. And if we're talking about it, it's a very kind of precise asset class. You know, it is on commercial properties. We've got to keep that in mind rather than the whole residential real estate market. Is it safe to say fixed income investment products? Is it still viewed as that? And it's
Yep.
just that it's backed by it. So the investors that are, clued in and listening, and what are you talking about there? This is what, they could potentially be involved in. There are, no doubt we'll get chatting about complexities, some of the obstacles in the way, etc. There's always people wanting to argue one way or another with these things. But why is it that you and your team, you actually see this not as just something that's going to hang on and survive through the pandemic, but you're seeing signs, you're seeing numbers and stats and so on, that this could really, really flourish? What is it that you're seeing?
Yeah, so it's a very good question. And actually the answer to that question, you really have to sort of rewind maybe 14 years.
Right.
To actually the beginning of this sort of, the century, in the noughties, because there what you saw between 2000 and 2007, what you saw in European CMBS market is a market that was really flying. The number of deals there were year on year were growing exponentially.
Right.
And the reason for that is, if you look in the US, there's a massive CMBS market over there at that period of time. And what you saw in Europe was kind of a replication of that. In many ways, Europe was following what they were doing in the US. And so what you saw was year-on-year exponential growth of CMBS issuance. And the drivers for that was that there was a lack of regulation. There was an increasing in interest rates. And so borrowers, banks, investors were very much incentivized to do these transactions. And basically what you saw was this exponential growth. But at the same time, the structures that were being used in the European market were untested. They'd never been challenged before. And what you also saw is you saw some structures that had been imported from the US and used in the European CMBS market, whereas you also saw some European structures used, which were a little bit more bespoke. And then you saw hybrids between the two.
Right.
And the long and short of it is when you hit the global financial crisis, everything just, that was the biggest stress test you could ever possibly imagine.
For anything. Yes.
And for me, suddenly it became interesting because people wanted to talk to me about what I did on the daily life, on the daily, my career, because anybody who's seen a Big Short, CMBS was very much the sort of the centerpiece of that film. And suddenly, the idea of repackaging debt and then into bonds and then repackaging those bonds and selling to investors was, became very much in vogue because it wrongly, in my view, got blamed for causing the credit crunch and therefore the global financial crisis.
Yeah, and you don't see it that way at all, don't you? Not you just do not see that. That was just an easy tabloid headline almost, isn't it? That's the bad guy. That's the culprit there. But you've got to delve deeper and get more of the details.
Yes, exactly. Because I think the bottom line is that CMBS was tarnished, and it would be fair to say that a number of structures were flawed. They did have issues. They did have problems.
Yeah.
But fundamentally, the product kind of worked, and the problem that it really had was that it just hadn't had chance to sort of grow at its own pace. It had, the big test it had was the global financial crisis. It could have done with a smaller test, which you sort of saw in the US in the late 90s. So remember, a lot of US structures were actually better than the European sort of bespoke structures. And so what you saw in the market is after everybody sort of, the global financial crisis hit, and then people started looking at CMBS again as a product. And what you saw was a number of policies came out in terms of structuring, best practice and sort of structuring deals. So the trade bodies came up with their sort of principles, like Cressy came up with some great principles in 2012 on how to structure CMBS. Investors came up with their principles. Regulators came up with regulation, which some of it can be criticised and heavily criticised at that. But the bottom line is they didn't basically destroy the product; they just made it harder to put CMBS together.
Yeah.
And despite all this, the reality is that you have seen a steady flurry of CMBS deals since 2012.
Yeah.
And the reason why I get pretty excited by the huge latent potential of the product now is that we've had the pandemic has had a profound impact on commercial real estate for the reasons that everybody is very aware of. And the reality is that CMBS has actually, as a product, all the issues that have sort of been thrown up by the pandemic, CMBS can deal with, quite frankly.
Right.
But not only deal with it, but actually deal with it in an open, transparent way. So if you have a hotel portfolio that's been securitized in a CMBS structure and it's defaulted, then the way that the counterparties deal with that default is played out in a public forum. And so therefore, if you have another hotel portfolio, then others can at least have a benchmark on what they did on another deal to work out that issue. And I think that's a very positive thing.
Yeah. I suppose that ties into one of the big criticisms it's had in the past is that around the valuations of these assets. Some people, that's the complexity that I'm not quite sure I've got the proper valuation on that particular portfolio, for example. Has regulation changed that? Do you think people view it differently and they have more of a security or more of a clarity on those things?
Yeah, so I think that's right. I think one of the big problems going back to pre-2007 is that loans were generally highly leveraged. You get to a situation where you may get a loan and you get a high level of debt on that, and then what you do is tranche that debt into senior and junior debt, and then you'd securitize the senior debt and then sell off the junior debt, and there could be multiple junior tranches of debt to third-party investors. And that created a lot of complexity, because what you had sometimes was a situation where you had a securitization which had a bunch of bondholders sitting behind it, and then you had a bunch of junior lenders, and then you may even have some mezzanine debt below that, and that creates a huge number of different counterparties, all when things go pear-shaped and there's a default, it creates a huge number of issues, and quite frankly, the CMBS market wasn't ready for that.
Yeah.
But going back to your point on valuations, what you've sort of seen since the global financial crisis, a lot more conservative approach has been taken to valuations. And there has been a fair whack of litigation surrounding valuations in the CMBS sphere. And so I think valuers have been also a little bit more cautious in the last, over the last decade. So I think a number of the issues around valuation have sort of, because people have basically more conservative, is no longer such a big deal as before, but who knows?
Who knows? And the numbers involved, I mean, it is quite impressive. There's been some reports, in fact, Reed Smith's shared quite a few of them, some of the stats with the European CMBS market in particular, exceeding like 1.7 billion in euros. I mean, we're talking big money, big figures there. So it is actually showing, the whole, the uptick, the rise that you're seeing. The stats are there to back up your actual optimistic approach to it. You're hopeful for the flourishing there. It is there to begin with, isn't it?
Yeah. So I think in terms of that, it's very interesting, because when you put together these CMBS deals, we're talking large. Most deals are normally northwards of 200 million. But there's been some big jumbo deals out there. German multifamily deals. In the 2 to 3 billion range. So there's been some huge deals. And if I think about the size of the European market before the financial crisis back in 2007, I think it was 65 billion issuance a year. I think the reality is that the numbers you're talking about in terms of financing commercial real estate through securitization, are big. I think it's always, and it's very useful to get fixated on the size of the market in terms of volume of issuance of notes, in terms of the aggregate amount. But I think also the number of deals that take place is interesting, because what you sort of seen is there is just a steady flow of deals, and you get more and more parties entering into that market, and and by having a steady flow of deals, it sort of creates the investor confidence that the market very much needs. Products. And in time, I think that will also lead to higher volumes of issuance. That's why I'm pretty encouraged at the moment, I suppose.
Yeah. When investors are seeing some of the terms around the CMBS area, the whole market, the niche, etc., we're seeing single sponsor CMBS, we're seeing private label CMBS. Can you speak on that? Can you describe how those work and how we should view those?
Yeah, so so when we talk about CMBS, I think there's two main sort of structures. And I apologise to any listeners who, who 15 minutes into this interview don't even know what I mean when I talk about CMBS. But basically, all you're talking about is a situation where you have, in the basic sense, you have a bank that advances a loan to a borrower, which is secured by commercial real estate. Yeah. And if they were then to securitize that loan, what they do is sell that loan to a special purpose vehicle, which is a shell company that's got no assets or liabilities. Mm-hmm. But that company funds the acquisition of that loan by issuing bonds into the capital markets. And that at its basic level is a standard sort of securitization. The complexities around it is when you sort of add a credit enhancement to that, and you sort of finesse the structure in order to produce a better bondholders, which ultimately gives the bank a better return, but also has certain features that investors really need for their investments, for their investment purposes. That's the basic sort of structure. There's another type of structure where there is no bank in the middle. Instead, a borrower could in fact just tap the capital market by basically by cutting out the middleman, by cutting out the bank. So there, in that situation, basically that special purpose company will issue bonds. The proceeds from those bonds will then be used to basically pay the borrower the cash that they need to either acquire a property or refinancing some existing debt. And typically you may see a bridge loan there. And so the European market, you see both those sort of structures in existence. If we rewound about 7-8 years ago, I would, and I was on having this interview now, I would say that agency deals are the complete no-brainer. And the reason for that is because you're cutting out the banks.
Yeah.
And you meant that sophisticated borrowers could be directly tapping the capital market, which to me was a complete no-brainer. And so that's what I thought would happen. Mm-hmm. What you've actually seen happen is actually a lot of banks actually continuing to advance loans and securitizing those loans. But what we have seen in the market now is that many of the CMBS deals that hit the market are really single loan deals. There may be maybe a couple of loans, maybe 3 loans, but that's a rarity. But what we've in the last few years basically we're seeing single loan deals. It's a massive difference to where we were before the financial crisis, where typically you'd see potentially 10 loans repackaged and securitized. One deal had pretty much 30 loans securitized. So we're in a very different place to where we were 15 years ago.
Yeah. Why do you think it took those turns? You were thinking it was going one way. Why do you think it's kind of morphed into a different way?
I think the reality is that there aren't. I think in terms of execution risk, it's a lot easier for banks to say, right, we're going to write the loan and then we're going to securitize it. Whereas if you have an agency deal where the borrower is trying to directly tap the capital market, you're putting, there's a lot of risk on being able to do the bond issuance at the same time as advancing the debt. And I suppose that's okay for refinancing, but in a situation where you're trying to acquire real estate, it's not that desirable. And so in that situation, you need a bridge loan. So you may as well just use the bank from the outset.
Yeah.
But, quite frankly, there's no reason why. I think one of the issues you sort of saw with the fact with the banks actually originating and then securitizing down the line is they came unstuck in the global financial crisis with this. But you sort of rolling back to I think 2015 when the market was doing pretty well, but then in July I think we had Brexit.
There it is now. I was wondering, I'd set an alarm. I thought European CMBS, when would we mention the B word, of course? And it's important.
I mentioned the G word, Brexit.
Yeah.
Greece looking to leave the euro.
Yeah.
And then in August, we had the Chinese financial crisis.
Yeah.
And so what you had then is you had a number of banks, I think, had originated loans with a view to securitizing. What ended up happening was they priced in the summer, and then they couldn't securitize in July because there was a lot of uncertainty. And then they couldn't securitize in August, September. And then, so their pricing kind of changed because of changing the macroeconomic outlook. And so you kind of take that sort of risk, as a bank originating and then securitizing down the line, they sort of take that risk. And I think that's not a great place to be as a bank. And so I think that shows one of the flaws with that sort of originate to distribute sort of securitization model.
Right. Okay. The asset class itself, you were talking about the product, we're talking about the security, we're talking about bonds. That's good. What's lying underneath all of that? This commercial property. If someone, an investor's looking at that, and you touched upon it at the start there, hotels. Oh, wait a minute, the hospitality industry. Large factories, call centres, offices. Whoa, wait a minute. If I'm putting my black hat on, I'm putting my devil's advocate on. I'm thinking, right, but risky. Oh, closure, death. Oh, it's all finished. The pandemic, everything. We're all in our homes. We're locked here forever. What's your whole thoughts and opinions on that actual asset class and how you see it going forward and recovering?
So it's a very good question, because that's what a lot of people are sort of thinking about. I mean, as securitization, the way it sort of works is, as an investor, you're buying a bond instrument, and that bond entitles you to receive interest during the life that you hold the bond. It also entitles you to principal at the end on the maturity of that instrument, or earlier if it's been deemed earlier. So those are the two fundamental things that you're entitled to. The great thing about securitization is it's tied into that. There is a number of sort of credit enhancement sort of features. So if there's a shortfall in payment of interest, then there could be a liquidity line that could be provided by a third party or the bank that put the deal together. But that liquidity line could be drawn on to pay you your coupon on your bond for a short period of time. So it's a kind of form of credit, I suppose, the transaction as a whole. So that's certainly helpful when you sort of have these sort of blips in these deals. And the other feature that these deals also have is that although the loan, for example, underlying loan, for example, may mature in, say, August 2021, the actual maturity date for the bonds is maybe 10 years down the line. And the reason for that is it gives a special servicer, the party that's responsible for maximising recoveries on that loan, which could be through enforcement or some other process. Then it gives them sufficient time to be able to maximise those recoveries. And so when we look at where we are in the sort of pandemic and the situation we are in now, I think that the bottom line is there's no rush to sort out a lot of these issues. Right. Which is very different to the banks, because for a bank that's holding an impaired loan, they suddenly have to start provisioning for that. It's going to start costing them money to sort of hold a loan on their balance sheet. It's also going to use up time and resource in terms of managing that loan, because you need to have regular conversations with borrowers, you need to be discussions with valuers, you need to work out, do you enforce that loan? Do you strike a deal with the borrower to put more equity into that loan? Do you restructure that loan? I mean, there's a whole schlepp of different things, conversations, and time and resource associated with that impaired loan. Whereas if you look at a securitization on the other hand, there's no problem with, you don't need to provision for it. There's no balance sheet pressure around that. The only thing you have is a special servicer whose job it is, and these guys are like a SWAT team. They're the specialists in sort of maximizing recoveries on the loan. And, they're experts in this stuff, and they will work with the borrower to maximize recoveries. And I think that's the beauty of CMBS, because you don't have that sort of time pressure.
Dealing with those blips that you spoke about.
So it sort of smooths things out. And that's why I think, this is the time for CMBS to flourish, because you don't have those timing pressures. It becomes very clear that you don't have those sort of provisioning issues which banks will, saddled with. And you also have, liquidity lines. You have a lot of support there. And all of this is played out in a public forum. So one of the big criticisms about, commercial real estate finance historically is the fact that it's all been done behind closed doors. There's a lack of colour or clarity or transparency about what's happening, what banks hold impaired loans, what's the situation with all these, where are we with valuations? There's always been a sort of residual concern about systematic risk by a bank holding a huge number of impaired loans secured by commercial real estate. Whereas the great thing about securitization is it's all done off balance sheet, and it's done in a public forum. And I think that's it's really healthy and a positive place to be, basically.
Yeah, that's it. It removes the shadows, and it brings that clarity that investors love. They want, that's what they're always seeking. I want clarity on my sums, on the returns, on the timescales, on everything. So the more that can provide, then the better they're going to feel, which in turn just increases the cycle of more and more business being done.
Yeah, yeah, no, definitely, and I think that's a massive positive.
Yeah. Now, you mentioned the D word earlier. I thought you were going to slide into the B word, but let's bring the B word up, the Brexit word. How did you see things happening on the build up to it, and then the point in time, and now after it, and things are, all the politics and everything else that's around it, for this actual market product, etc., investment vehicle, how has it dealt with things?
Yeah, it's been an interesting time for CMBS as a whole. I sort of tracked it, from the early days of my career. It's not what I thought I'd end up doing, but I sort of, it's like the way I describe it to some of my colleagues, to make it more interesting, I suppose. It was like we were in this massive party on the dance floor and somebody switched the lights on. And that's what happened in 07. And ever since then, I want to get back on that dance floor and the lights, off and disco. And, quite frankly, I keep thinking we're going to get there, and we haven't really quite got there.
Yeah.
And I think, the first deal to come out after the financial crisis came out in 2011. You've had a steady flow of transactions since 2015. As I was referring to Brexit and the Chinese financial crisis, created a couple of years of, no activity. You've also had the overall, sort of Damocles in the form of regulation has always been a big concern, because there's been a lot of regulatory uncertainty over the last 10 years. But again, with the Securitisation regulation coming into play on the 1st of January in 2019, a lot of the uncertainty and question marks around that has fallen away.
Yeah.
So we're now in a place where things are a lot more steady. And I think Brexit was just, for me personally, I've seen it as, just another uncertainty amongst all those other sorts of uncertainties.
Yeah. It's just one more data point, one more thing to deal with.
Exactly.
And we're always going to have that, aren't we? But because of the nature of it, with investments, with property, there's always cycles and phases and ins and outs and dips and so on. So it's not as if we're going to wait for a final point. We're just going to carry on this way, aren't we?
Yeah, I think that's right. And I think ultimately CMBS, in an ideal world, the underlying collateral is secured by real estate, not in the UK, but UK, France, Germany. The best pools are the ones which have a good geographical spread across a variety of different types of commercial real estate asset classes. You want your offices as well as hotels, as well as retail, all in the same pool, because then you take the rough with the smooth, you sort of spread that risk around. And I think, Brexit is just a classic example, one of a big point, but it's not really, in my head, hasn't really impacted the product.
Yeah, it's not a be all and end all.
No.
Yeah.
No.
Yeah, excellent. I want to be respectful of your time. I'm enjoying this conversation, but I want to be respectful of how long I'm hanging you on, because you're a very, very busy man. We spoke at the start about the US market, which really led the way with it all, and then there was a slight lag with Europe coming in, and you spoke about how it started to copy US in one way, completely go Euro specific in other ways have a hybrid, etc. You spoke about that part of the puzzle. Fast forward to now, how do you see it now? Are there still changes? Is there still a lag between the two, or are we very much kind of going side by side? How do you view that?
Yeah, so the US market is a completely different kettle of fish. And it is frustrating, because when I talk about CMBS, and it's been a challenging few years for the products in Europe, well, since the financial crisis. Whereas you look across a pond, and they have record issue, and the market really bounced back pretty quickly.
Yeah.
And it has gone strength to strength. You also see a very active CRE CLO market, which is a different type of structured product, but again, the underlying collateral is loans secured by commercial real estate. You don't have that in Europe at the moment. Although there's no reason why you won't see that coming in our direction soon. So I think for me, I look at the US and I always think that's where they are now. we generally normally follow suit. It just takes a bit longer to sort of get there. And I think, and for me, when I look about the potential of the products, given all the positive attributes I've alluded to in this conversation, the fact that you have such a massive market in the US and the fact that Europe is so far behind it, it just shows there is a gap that that we need to sort of fill in Europe, and I'm sure we will do.
You're not being biased with your past here, are you? I mean, that's what, the Bank in New York, you're not being biased and wrapping Uncle Sam's flag around you, are you? Brilliant stuff. So, high level, the economy as a whole, every part of the kind of finance structure going forward. What's your own just general view? Everyone's looking for these people with the crystal balls on their desks and so on, but how do you see, the rest of 2021 going?
It's amazing to think that we're like at the halfway point, the longest day of the year.
It's incredible.
Days, and it's fascinating because I was having conversations a year ago, and people were saying that it's been crazy busy, and quite frankly, it has been a crazy busy year. You're seeing a lot of. I think last year you saw a lot of deal activity sort of stop or pause or sort of stagnate a little bit, just due to the sheer uncertainty. But what I saw this year is a lot of people fixated on getting deals done, getting transactions done, things that they wanted to do last year. They've realised that they can't, continue on pause, and they have really sort of been fixated on getting things done. So I think this year is going to be a bumpy year. Especially in the legal sector. I've never known such a busy year really. So
is that right?
I think September, or I think the last quarter, or the last 4 months this year could just be crazy busy.
Right.
If all the lockdown restrictions have been removed, and the economies and everyone's just going through it. And I think it's a very strong finish.
Because there is a lot of pent-up pressure there, isn't there? I mean, you spoke about the pause button. It really is. It's this long pause button. At the start, we thought, a couple of weeks, this is good. Come on, let's take it on the chin, deal with it a couple of weeks, and then let's get back to business. And the longer that it went, that pressure has just increased, and it needs a release. And it's all parts of it's the people involved, the humans, it's the actual investments and products and structures, and then it's just the economy and the supply and demand as a whole. We just need to move on, don't we?
We do, but it'd be interesting to see. There's also a lot of things on life support at the moment. There's a lot of help out there, and how you sort of unwind a lot of that stuff. A lot of those measures. It'll be interesting to see how that sort of plays out. And then also the underlying, when people are going out buying assets or loans or what have you, there's always a bit of a gap between bid and ask spread, and until that closes a bit more, I think that will subdue activity. But I think I'm pretty confident that we're going to have a very busy last quarter.
It's a nice optimistic view. Then of course we'll complain about how busy we are, because that's what us humans do. We complain when it's quiet, and then we complain when we're far too busy. The last wee point, actually, just on that front, just going low level, going into your own little bubble, the structured finance team at Reed Smith. How do you see that going forward as well? Is it going to CMBS? That's the full focus. This is what we're all about. Or you see different threads and projects that you're going to veer off into?
Yeah. So I mean, our team is a big team. We have 30 lawyers in that team, and I definitely fly the flag for CMBS. I also fly the flag for non-performing loan securitisation, which in my eyes is a nuanced version of CMBS, but we're heavily active in auto loan securitizations, residential mortgage-backed securities, trade receivables. There's a whole range of different sort of structured products out there which we're heavily involved in. And one of the big things is LIBOR replacement. We've got massive teams involved in working for a whole range of different clients and to redocument, reposition loans and transactions, some big securitization in this LIBOR space. So from our perspective, we are super busy. And as much as I like to fly the flag to CMBS, I'm only one of the cogs in a rather large machine.
I've got a big fear for you, Ian. I can see less and less time for geology and rocks. I really can. It's going to go this way.
Exactly.
But I do hope you do hang on to it. Keep checking in with those books and stuff. But listen, this has been fascinating. I absolutely love it. And I'm sure our listeners, our viewers are going to get a lot from it. Remember, folks, when it's safe to do so, go into the show notes page. You'll see all the links to hook into this man, hook into his team, and follow along with them, because they're always producing little snippets and reports that they publish on their site as well about these kind of things. This is one of the fascinating things that I'd read a while back about, CMBS version 2.0. And what's all that about? Well, people at Ian, people at his team, they're focusing on these things and making sure they keep on top of it. So make sure you follow those people. So Ian, for your time today on the show, thank you very much indeed.
Yeah, no, thank you very much.
Well, I hope you enjoyed today's show as much as I did. Remember, with the guests that you just saw, go into the show notes for the page because all of their links are there so that you can get in touch and to get more information. And talking about getting more information, more guests, more insights, more knowledge, etc., make sure you're subscribed. Get the subscription done, get the notifications on, and then we'll always keep in touch with you every single time a brand new show is going to come out. So thanks for tuning to This Week in Property.